NVIDIA stock is currently trading at $194.70 during today's trading session, reflecting an intraday gain of 1.01%. While the broader market appears to view this modest upward movement as a simple relief rally, the underlying reality reveals a much deeper, counterintuitive shift in how the semiconductor giant is being valued. For months, the consensus narrative around NVIDIA stock focused on the assumption that its rapid ascent would naturally lead to a permanent premium valuation, making it an expensive play forever locked in an exclusive tier. The reality hitting institutional order books right now completely upends that thesis. Instead of trading at a massive premium, this recent price action has actually pushed the chipmaker down to a forward price-to-earnings multiple of roughly 18 times projected earnings, making it technically cheaper than the average stock in the S&P 500 and significantly discounted compared to the tech-heavy NASDAQ 100. This presents a striking contradiction for anyone looking to invest online. The company that currently commands an estimated 80% of the AI accelerator market by revenue is being priced by public equity markets as if its structural growth has completely flattened out, even as its fundamental corporate earnings estimates are revised upward by Wall Street analysts. When retail traders browse modern investing sites or check their individual brokerage accounts, the general sentiment regarding NVIDIA stock often feels anxious, shaped by headlines highlighting a 16% drop from its mid-May highs. The common assumption is that competing semiconductor manufacturers, particularly those supplying high-bandwidth memory, are eroding the core profit margins that made the company a trillion-dollar powerhouse. But looking past the immediate noise reveals a massive disconnect between sentiment and structural spending. Major hyperscalers, including Microsoft, Alphabet, Meta, and Amazon, are on track to spend an aggregate $650 billion on digital infrastructure this year alone, with projections moving toward $1,000 billion by next year. Because NVIDIA stock is deeply tied to this hardware layer, the current price weakness is less about a breakdown in demand and more about a mechanical rotation of capital. Large institutional managers are shifting allocations out of front-running chip designers to fund positions in memory, storage, and infrastructure components. This has created a unique situation where retail platforms like the Robinhood stock trading or in interactive brokers trading channels show heavy trading volume but relatively stagnant price action as retail buyers absorb the supply shed by institutional rotation. To fully understand what is driving the daily swings in NVIDIA stock, one must look at the tension between short-term hardware supply chains and long-term architectural dominance. A major point of friction in recent weeks was a rumor suggesting that the company's high-end rack scale system, the Kyber NV144, would face severe delays, pushing its release out to 2028. This caused immediate downward pressure across major trading platforms, causing retail investors using self-investing tools to worry that the product roadmap was fracturing. The company explicitly refuted these claims, confirming that the Kyber rack system remains precisely on schedule. This specific episode perfectly demonstrates how fragile short-term market expectations have become. Investors are hyper-focused on any sign of execution failure, while completely ignoring the pricing power inherent in the upcoming Vera Rubin platform. Bank of America analysts recently noted that the market is overestimating the margin squeeze from rising high-bandwidth memory costs because they fail to realize that the next-generation architecture will command substantially higher average selling prices. This pricing power ensures that corporate gross margins are highly likely to remain stable in the mid-70% range, a feat almost entirely unique for a hardware company operating at this unprecedented scale. For context, comment below how many shares of NVIDIA stock you currently hold in your portfolio and whether you are buying this dip or shifting capital elsewhere. Looking at data from popular platforms like Robinhood stock trading or an interactive broker's premium account reveals that while individual investor interest has seen a minor consolidation over the past month, the long-term accumulation trend remains intact. This trend is supported by an expanding global footprint that goes far beyond domestic cloud providers. The company recently confirmed that 35 new high-performance supercomputers utilizing its architecture are currently under development across Europe, focusing heavily on life sciences and sovereign institutional research. By deploying specialized software toolkits alongside physical graphics processing units, the business is effectively locking in its customer base at the software layer, making it extraordinarily difficult for clients to migrate to alternative hardware platforms from competing semiconductor firms or custom internal silicon programs. When evaluating this sector through modern online investment platforms or tools like Schwab Intelligent Portfolios, comparing foundational business models becomes critical. The primary argument used by short sellers is that custom internal chip programs, such as Google's custom processing units co-designed with major chip intermediaries, will eventually eliminate the need for third-party merchant silicon. However, historical data tells a completely different story. These custom internal programs have existed for over a decade, yet during that exact same time frame, merchant data center revenue grew exponentially. The reality is that building a custom chip is highly localized to specific internal workloads, whereas a standard graphics processing unit cluster provides general-purpose computing capabilities that can be dynamically reallocated for diverse AI training and inference tasks. This operational flexibility explains why the company is projected to maintain a dominant 65 to 70% long-term market share in hyperscaler infrastructure spending, even as alternative options become available. To put the financial health of the business into perspective, one only needs to examine recent quarterly reports. Total revenue has shown immense structural stability, with gross profits reaching over $61 billion in recent periods, driven by data center allocations. Operating income has mirrored this trajectory, climbing above $53 billion, which flows directly into a massive cash cushion that protects the company from short-term macroeconomic headwinds. This level of cash flow generation gives the management team immense flexibility to reinvest in research and development, secure advanced manufacturing capacity from foundry partners, and execute share buybacks that support equity value over time. When retail investors utilize a Fidelity trading platform or track performance via a Fidelity mobile app, these fundamental metrics often contrast sharply with the volatile, sentiment-driven stock charts visible on daily timeframes. The stock is currently consolidating within a clear descending channel pattern, testing clear resistance lines between $198 and $203, with a neutral relative strength index indicating that a definitive breakout direction has not yet been established by short-term traders. Ultimately, the trajectory of NVIDIA stock will be decided by how reality resolves against these compressed market expectations. The prevailing market narrative assumes that the hardware build-out is a cyclical peak that will abruptly drop off once initial model training is complete. The deeper structural reality suggests that the transition from traditional data centers to accelerated computing centers is a multi-year architectural upgrade that is still in its opening phases. As software applications become increasingly agentic and autonomous, the demand for continuous inference capacity will require vast amounts of localized computational power, sustaining hardware utilization rates far longer than traditional hardware cycles suggest. For individual self-investing accounts managed through Fidelity Investments, SoFi Active Investing, or Interactive Brokers platform interfaces, this structural shift highlights the importance of separating short-term capital flows from core operational execution. While institutional rotations will continue to create sharp, unpredictable daily swings, the fundamental earning power of the underlying business remains anchored to the physical infrastructure of global computing. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.